All right, so here is my best effort for you to be able to have extra more examples and questions and things that you could look forward to the very first exam. Okay, so here is a study guide for you. I've compiled this. So you have extra examples so you can have for the tests again. Now I've broken up into each chapter, so again, that's why we're gonna go through just only chapters 1 through 4 today. But let's go ahead and just dive right in. So again, these are gonna be similar, but not obviously exact questions on the exam. This is what you can be tested or could be looking forward to. So let's get started with chapter 1. Okay, what is accounting?
A.
It is a process of recording and sorting and summarizing all business transactions and events. Good. That is letter A. Okay, it's definitely not B, the process of creating formulas, the process of elimination. And then letter D, once again, is only a partial portion. Okay. Number 2, which of the following areas of accounting does financial, managerial, financial planning, and treasury accounting belongs to?
B.
Yes, private accounting, right? Right? These are all things that are done on a smaller scale. Ooh, who's that? Oh, sorry. Okay, so back to the study guide. Um, Number 3, okay, which of the following is not a business organization?
Okay, D. All above.
Yes, they are all business organizations. So again, yes, we talked about sole proprietors. Yes, we talked about partnerships, and yes, we talked about non-profit organizations. Okay. Number 4, okay, which of the following financial statements is based on the accounting equation? Okay, assets equals liabilities plus equity.
A.
The balance sheet, right? Hence, the formula, you're balancing the formula, right? If you have too many assets and not enough liabilities, you're not going to be balancing your books at all. So in this case, balance sheet is the correct answer, right? Profit and loss, test for profitability. Okay, statement of cash flows just sees where your money's flowing in, flowing out. And of course, the statement of owner's equity is going to be the value of your company. So in this case, A is correct. Okay. Number 5, what is the difference between the accountant and the bookkeeper?
A.
Let's see, A. The accountant records, creates financial statements, and analyzes business transactions, um, while the bookkeeper only records business transactions. That is true. Okay. All right, now we're moving into chapter 2 territory here. So, answering the following questions using the chart below. So, again, this is what I want you to do. Okay. We did this exercise in chapter 2, right? This is what I can ask you. I'm going to give you an account. It's going to have a brief description on it, right? And you are to determine the account type, the account category, and the normal balance. So, for instance, right, the first one, so you're going to have a bunch of options. Since it's multiple choice, right, that means I'm going to have the series of answers for you, right? It could be, for instance, it could be asset, other, credit, right? Asset, fixed, debit, liability, current, debit, right? You know what I mean, right? So that's how I'm going to ask the questions, and that's how you're going to answer them by um by filling in the correct answers in the correct chart. So this one's we're gonna practice that so we can go ahead and identify that. So first we need to know what the asset types are. So again, there are only 5 and 5 only. You got asset, liabilities, equity, income, or revenues and expenses. Then you have all the types of categories, right? You have current, other, fixed, long term, okay, other income, sales, cost of goods sold, operating expenses. Okay. So let's go ahead and determine this one. So of course, each and every single one is going to have its own separate question. So for this exam, you have 10 account questions. So I can give you any account. Okay. And you are to determine the account type, category, and normal balance. So for instance, cash. What type of account is cash?
It's an asset account.
Yes, it is. What kind of asset?
A current asset.
Correct, right? Because it's already in its liquid form. It's already available in cash. Ooh. Okay. And what kind of normal balance would this cash account have? So this is where your
Debit.
accounting model is going to come into play. Yes, because it is an asset. It normally increases with a debit. Okay. What about accounts receivable?
It's an asset.
What kind of asset?
Is it current?
Yes, it is, because remember, accounts receivable is what people owe you, right? Your customers
Right.
owing you money. You can bill them and get the money as soon as possible. You can call them. You can have them say, hey, you know how they have that phone operation where they say, hey, you can enter your debit card or credit card and be able to pay the bill instantly. Yes, you can do that. So debit. No, well, I should give you the answer to that one. Sorry. All right, inventory. What kind of what kind of account is inventory?
It's an asset.
Yes, what kind of asset?
Um, Fixed.
Okay, so in this case, it's not fixed. Okay. Reason for it is because when you have inventory, right, under a merchandising kind of company, what can you do with this inventory?
Okay, what was it? Would it be operating expense?
Well, we have it as an asset, right?
Right.
So there's no way it could be an operating expense.
Okay, I'm trying to.
So use your review sheet, right? What are the categories of assets?
Okay, it's under current.
Yes, it's current. You know why? You can turn around and sell your inventory and get cash for it immediately. Okay? So then, what kind of normal balance would this have?
A debit.
Yes, it would have a debit balance. Okay? So next one we have is equipment. What kind of account is equipment?
An asset.
It's an asset. Now, what kind of asset?
Current.
This one would not be current because can we actually sell our equipment for cash and get it instantly?
No. So would it be a fixed asset?
Yes, because it's part of PP&E, property, plant, and equipment. Okay, and what kind of balance would this have?
A debit.
Okay. All right, next one we have land. What kind of account is land?
It's an asset.
Yes, it is because you own the land, right?
Right.
So then what kind of
It would-
asset?
It would be fixed also.
It would be fixed also because it's part of the property, plant, and equipment, right? This is property.
Right.
Okay, and what kind of balance would this have?
Debit.
Yes. Okay. What about a prepaid account? So for instance, prepaid rent. You paid for it in advance.
Would it be a liability?
Not necessarily. You make the payment in advance, so you don't owe anybody money.
Okay.
You paid in advance for services. For instance, rent, right? You normally would have to make at least 2 months in advance payments and then a deposit, and then you have to pay for the current month, right? Normally. So if that's the case, and I have prepaid rent because I had to pay 2 months in advance. That's a prepaid account.
Asset.
It is an asset, right? Because now you own that property rented out to you for those 2 months.
Right.
All right. Now, what kind of asset?
A current.
In this case, if you paid rent to your landlord, can you tell me, will you be able to get it back?
No.
Okay. So it can't be current because you can instantly convert it into cash. So if you can't get your money back or it's going to be very difficult, right?
Right.
Then what kind of account would this, what kind of type of like asset would this be?
It would be a fixed asset.
Not fixed, because fixed has a tangible property to it. Can you physically touch rent?
No.
No, you can't. So what's the last category for assets?
So would it be a liability?
We went over this.
Okay.
I paid someone in advance. I
Okay.
don't owe anybody anything. I own the rent for 2 months, right? So it's definitely not a liability. We established it's an asset. Now there's 3 categories for assets. You already gave me 2 of those 3. What's the last one? Use your review sheets.
Would it be operating income?
It's not income. We are established that it's already an asset. And how would you generate income if you paid somebody money? Norman, do you know?
Sales.
It's not sales because we didn't generate money. We paid somebody in advance for services. We paid rent ahead of time. So how am I generating income if I paid rent ahead of time?
Okay, would it be other assets?
It would be
Non-operating income.
it would be other assets. Why? I've mentioned this many times before, right? What constitutes as an other asset? Usually it doesn't have tangible properties. I mean, it's an intangible asset, intellectual property, right? We talked about this. Can you physically touch rent? The idea of
No.
rent? No.
No.
But you own it, right?
Right.
Because we made a we paid in advance for rent. So that means the landlord owes me service. I own this rent property because I paid for it. But you can't touch rent. So in this case, it becomes an other asset. Okay? What else?
And it's debit.
It would have a debit balance, yes. Okay. What about accounts payable? When you owe vendors money.
That'd be a liability.
Now that's a liability because you're owing people money. Okay. Now what kind of liability would this be?
Correct.
It'd be current because most likely you're not going to owe them for more than a year. So, what kind of balance? It'd be credit balance. Okay. What about unearned revenue? When a customer pays you in advance.
Okay, that would be asset.
No.
Or income.
Well, you haven't done the job yet.
Well, let's put it as it'll be revenue.
Well, in this case, no, because you haven't completed the job yet. Someone paid you for services that you haven't completed yet. So a customer paid you in advance. So for instance, right, you require you require a down payment for you to do your services.
Right.
So if someone paid me to do something and I haven't done the job yet, what happens to me? What am I required to do? If we signed a contract, right, that you're gonna give me $1,000 to do a service for you, and we already agreed on the date, and you paid me $1,000, what am I legally contracted to do for you? I owe you services, right?
Right.
So then, if I owe you services, what kind of account would this be?
Would it be a liability account?
Of course, because you owe something, right? You owe somebody. It doesn't have to be a vendor, it could be a customer. In this case, unearned revenue. You haven't earned the revenue yet. That's hence the word unearned. You haven't completed the job yet. Make sense now?
Uh-huh.
So in this case, because I haven't earned the revenue yet, because I haven't completed the services, it now becomes a liability because now I owe a customer service. So in this case, yes, it is a liability. Now, what kind of liability?
Um, long term.
Do you think a customer is going to be happy that you paid them a year in advance and they don't show up to do the job until a year later?
So it'd be current.
It would probably most likely be current because besides wedding venues, I don't know any job that is going to allow them to have a customer pay in full in advance and then expect the job to be done a year later. Except for construction. I think construction might be done, but will talk about progress invoicing later. Okay? So in this case, yeah, it's most likely going to be current because, again, a customer's not going to be happy if you're going to wait, if they're going to pay you and a year later, you're going to do the service for them. Okay? Unless it's scheduled. So therefore, what balance would this have?
A credit.
It would have a credit balance. Okay. What about a loans payable?
Okay, that's liability.
That's for sure a liability.
And that should be a long term.
That should be long term because usually most small business loans minimum is at least 3 years, okay, to pay back. Now, if it is in its title, you can have a short term loan that's 6 months long, okay? But typically, those are usually like commercial loans that you just need a quick, a quick borrow up, and then that money gets paid back immediately. But in this case, most typical loans are long term. They are definitely more than 1 year. Okay, and what kind of balance would this have?
Credit.
Credit. Yes. Okay. Number 10, owner's equity.
That would be equity.
Yes.
No category.
No categories. Excellent. And what kind of normal balance would an owner's equity account have?
Would be debit.
Well, look at your model. How do you increase equity?
It'd be quick credit.
Yes, you would credit and that would increase equity. What about an owner's withdrawal? If the owner decides to take money away from the company, an owner's doing a withdrawal.
Okay, would it be equity?
It is an equity account. Good. Now, what kind of equity?
None.
None. Excellent. Now, in this case, are you increasing or decreasing equity?
Decreasing, so you're going debit.
Yes. Excellent. Debit. Good. What about a sale?
Revenue.
Yes. Revenue or income, whichever one that you refer it to. Okay. Now, what kind of category does sales belong to? Look at your options. You have other income, you got other, you got fixed, you got sales, you got cost of goods sold, operating expenses. Which one would it be?
Wouldn't the category be sales?
Yes, it would, because in this case, right, we're doing merchandising inventory, merchandising type of activity, right? So yes,
Right.
sales or operating income. Okay, it's not on there, but if you know it as operating, because this is the main core of generating income, would be through sales. Okay, and what kind of normal balance would this have?
A debit. I mean, a credit.
Yes, it would have a credit balance. Good. Okay. And then we have cost of goods sold. Cost of goods sold basically calculates how much it costs you to sell a product.
Would it be revenue expense?
Which one, revenue or expense?
Expense.
It is an expense, yes, 100%. It's directly correlated to your revenues, yes. So again, cost of goods sold is what matches your sales, right? Which is your revenue. So in this case, what kind of expense account would this be?
Operating expense.
Not operating. What are the categories for expenses?
Would be sales expense.
You can't have a sales and an expense together. Do you have the study guide in front of you?
No.
Okay.
Not exactly. Not exactly.
So in this case, what are the options?
Okay. Cost of goods sold.
Cost of goods sold has its own separate category for its own self, because this is how we calculate how much cost it is for me to sell the product, right? And that's how we update our inventory, through the cost of goods sold. Okay? And then last but not least, what kind of balance would this have?
Credit balance.
Not credit.
Debit.
Yes, because in this case, if you look at your accounting model, right, only assets and expenses are increased by debit. Everything else is increased by credit. Okay. What about rent expense?
It's an expense.
Yes. What kind of expense? This one should be obvious.
It's a current expense.
There's no such thing as a current expense.
I mean, it's a liability.
We already established it's an expense.
Mm-hmm.
What are your options?
Is it operating?
Yes, right. You need to have rent in order to operate your business, right?
Yeah.
Right? And what kind of balance would this have?
Uh, Credit.
Not credit.
Debit.
Yes, so remember, assets and expenses usually flow in the same direction. Everything else, so liabilities, equity, and revenues, they are all increased by a credit. Okay, so that's your accounting model there. And last but not least, supplies expense.
Okay, that's an expense.
What kind of expense?
That's an operating expense.
Operating expense.
And it's going to be a debit.
Yes. Good. All right. Question number 9. What does left mean?
A,
Debit. Good. What does right mean?
credit.
Yep, it means credit. Okay. All right, number 11. Okay. Your company had a total assets of $125,000 and a total liabilities of $45,000. What is the total owner's equity?
Would it be D?
D, $80,000. Yes, because in this case, right? What's the formula? What's the accounting equation?
Assets
Mm-hmm.
equals liability plus equity.
Yeah, so if you have a total assets of $125,000 and you have a total liabilities of $45,000, what is equity? So you can take $125,000, subtract the $45,000, and you should get $80,000. Good. Number 12, okay? Which account types normally have a debit balance?
A. I'm sorry, D.
So the entire time we were journalizing when we had a sale, we debited the sales and debited cash. No, that's not true because our debits and credits have to match, right?
Right.
So look at your accounting model. Can you tell me what is the same and what is different? Look at your accounting model. Okay. Which ones are increased with the debit?
Assets.
Assets for sure. We just went over this 3 times, in fact.
And liabilities.
Does a debit increase or decrease liabilities?
Decrease.
Okay, so you know what the definition for the normal balance is, right?
Right.
So it's whichever side that increases on. So does a liability increase with a debit?
No.
No. So then liability is not one of them.
So is it expenses?
It's expenses. Yes. I said that 3 times already when we're doing the chart over there. Assets and expenses usually flow in the same direction. Everything else flows in the opposite direction. Okay? So in this case, your answer is C. Right? Number 13. Which of the following account types are temporary accounts?
Revenue and expenses.
Revenue and expenses. Good job. Okay. Now we're moving in chapter 3. Okay. When journalizing a transaction, which statement is true?
I see 2 of them.
Okay, elaborate. Tell me what you're thinking.
Okay, after I read it again, no. Okay.
Okay,
I said debits equals credits.
that's correct, right? So let's go over the answers. Debits are recorded last. Is that true?
No.
No, they're recorded first, right?
Right.
Credits are recorded first, obviously, right? Those
No.
are flipped around. Descriptions are account names only. Is that true?
No.
No, right? We do actually put a full on description, right? It's not
Well,
strictly just only your account names because then it'd be mere impossible to tell the difference between a bunch of accounts, right? You're going to be having the same account but no description, it's not, you're not going to know what happened between those days. You have to have an incredible memory. But again, if someone's doing this for years and years, do you think someone has the capacity to remember the exact transaction that happened 5 years ago?
No.
Exactly, right? It's almost near impossible, right? Unless you have a time machine, right? All right. So debits equal credits is true when you're journalizing, right? Every action has an equal and opposite reaction. So remember, little applied science in here. Number 15. What are the methods to use to correct errors in the journal?
D.
D, A and B only, right? You got the error cancellation method and you got the reverse and reentry, right? I never taught you a cross it out method. Okay, that would be nice if you could just cross it out. Number 16, okay? You made a purchase of office supplies for $56 cash. And of course, you recorded it in your books as office supplies for $65. Okay, correct the error in this entry using both methods. So in this case, let's practice the reverse and reentry. So in this case, I put in my books that I purchased $65 worth of supplies when in reality I only purchased 56. So how do I reverse this entry? What was the idea I gave you, right? It was to go to the store and return the product, right?
Yes.
So how do I return the product?
Excuse me.
Norman, you want to help answer this question? How do I return the product?
Okay, it would be office supplies for $56 when it was originally written, and it would be cash for the $56. To reverse it, you will put the same date, and you will put $65 for office supplies and $65 cash.
What comes first? Are you debiting the office supplies or are you crediting the office supplies?
Um, I'm debiting the office supplies for $65 and
Wrong.
credit.
I'm reversing this transaction. Right now, I recorded it as office supplies, debit for $65, cash credit for $65. That's my original transaction. Now my question is, that's wrong.
Okay.
It needs to be $56 instead. Right. So how do I reverse the entry? I'm doing the reverse and re-entry method. How do I reverse it in the first place?
So would it be $56 debit for office supplies and $56 credit?
Right now, I have $65 worth of office supplies right now in my account. Is that true?
No.
So how do I undo this? Because that's an error in my journal. How do I undo that? I have to reverse the entry, right?
Right.
So I have to go to the store and return the office supplies, right?
Right.
So if I'm going to return the office supplies, what should I be getting out of that?
Cash.
Cash, right? How much cash should I be getting back? If
$56.
no, yes, $65, and I'm going to also be returning the office supplies. for $65. Okay? Now that I
Right.
returned the product. Now, the next step is I need to re-enter the journal for the correct amount. So, now that I returned the product, I need to go buy it again. So what would I journalize this as?
So it would be office supplies,
Mm-hmm.
and then cash.
Yes. For what amount?
$56.
Yes. Okay, so that is the reverse and re-entries. That you have to go undo the transaction first, then you're gonna re-enter it in for the correct amount. Okay. So now we gotta do error cancellation, right? So in this case, right, what is the first rule for error cancellation? I need to determine the difference between the 56 and the 65. What's the difference between the two?
$9.
$9. Okay? Now, this is where we have to think. Am I over or am I short in my office supplies?
You're short.
I originally recorded at 65 when it needs to be 56. So, do I have too many office supplies or am I short office supplies?
You're short office supplies.
You have $65 worth of office supplies right now when you need to have 56. Do you have too many office supplies or are you short office supplies?
Too many.
Now you have too many, right? Because
Right.
you have $65 worth of office supplies. You need to make it down to 56. So, am I going to increase my office supplies by $9 or decrease it by $9?
Increase it.
We're at 65. You need to get to 56.
We're going to decrease it.
We're going to decrease my office supplies by $9. Okay? Now let's think about the cash. Did I spend too much or am I short in spending the cash?
You spent too much.
You spent too much, so then you need to put the money back. So you would do that by increasing your cash because that $9 needs to go back to your cash into your pocket, right?
Right.
Okay. All right. Okay, number 17. Okay. What is the difference between the general journal and the general ledger?
D.
D, all of the above. Let's see. Well, let's see. General journal has a list of all of the transactions with balances. Is that true?
Yes.
General journal, the journal, is a list of all of the accounts with their account balances.
Okay, no.
No, it's not. Okay. Letter B. General ledger only lists the daily business business activities and transactions. Is that true?
No.
C. General ledger is a list of all of the accounts with balances. General ledger is a list of all of the accounts with their balances.
Yes.
Yes. Okay. All right, moving into chapter 4 territory here. Okay. Which of the following steps belong to the accounting cycle? Okay. Here we go. Okay.
It would be all.
It will be all of them, right? Because in this case, yes, you need to collect your source document, analyze, you've recorded in the journal, post it to the ledger, do the trial balance, then the adjustment, then the adjusted trial balance, financial statements, close the books, and post closing trial balance. Yes, all of those are all the steps. Okay. Number 19. Which of the following is not a characteristic of financial statements?
B.
Yes, you there's it's kind of difficult to explain if it has to be reasonable, right? Why
Right.
would a financial statement need to be reasonable? It's not an argument you have to win, right? So there's no point to have a reasonable financial statement. Okay.
How you say you
Number
can have questionable but not reasonable.
right. All right, number 20. Okay, under the rules of GAAP, which rule states that personal assets should be separated from business assets?
A.
A, business or economic entity, yes. So you can get definitions or you can get applied knowledge. Okay. Number 21. Okay. Under the rules of GAAP, which rule states that when recording a transaction, okay, it should be recorded in terms of money or value?
B.
Not historical cost. Okay? Historical cost tells me that when I purchase an asset, I have to record it for its fair market value at the time I purchased it. Meaning, if it's $50,000, I have to record it at $50,000. Okay?
Okay.
This this rule. Go ahead.
Would it be C?
Monetary assumption, yes, because this is a monetary measurement where it tells you you cannot record a transaction in terms of quantity, right? It has to be dollar value. So that's what this question is asking me is when I journalize, it has to be in terms of dollar value. It can't be quantity, okay? So in this case, this is a monetary assumption, yes. Okay. All right, number 22, under the rules of GAAP, which rule states that when making a purchase of an asset, okay, they are recorded at the original selling price. The value does not change over time. So this one is what?
Uh, Historical cost.
This one is an example of historical cost, right? Because when you're purchasing an asset, right, you need to record it at the original selling price. It's fair market value, right? At the time that you purchase it. And it stays the same in your books throughout how many long you have that asset for. So in this case, this is historical cost. It doesn't recognize gain or any losses until you get rid of the item. Okay? Number 23, cash basis is when?
When transactions are made with cash.
Okay, so which letter is
And,
that?
and if you have your expenses, you make the payment with the cash.
Okay. So, letter
A and B.
A and B, correct, right? So in this case, yes. Revenues are only recognized when cash is received, and then expenses are only recorded when cash is readily available to spend. Good. And then last question of the day, question number 24. Accrual basis is when?
LBC.
It will be C, right? Incurred, right? Incurred meaning at the time the job has been completed, right? When it
Right.
happened. That's what incurred means, right? Then you're going to record your expenses. Good. All right. So again, tomorrow we'll finish up the study guide with chapter 5 and 6. We'll go over the PowerPoint to go ahead and understand